So you are getting how much return? 100,000 multiplied by 6%. It gives you 6,000. So let's suppose if you invest in business A, and obviously you have to remove your investment from here and then put here. You understand? I mean, if I can show it to you like this. Strike through, yes. So you have to take your money out from here and you have to invest here. Then how much should you expect in return from that business? Higher than the 6%. Because 6% is this is what we call, if you remember, we have already discussed it, it is risk-free return. This is risk-free return, if you remember. So here you are not taking any risk. Now, if you're putting your money in business A, you are taking risk. So your return should be higher than 6%. So let's suppose you aim for maybe 12%. And it will be 12,000. So it means that you are asking for 12%. Why? Because you are foregoing this 6% also. This is called opportunity cost. This is known as opportunity cost. The opportunity you are foregoing for investing your money in business A. Right, sir? Is this clear?
Yeah.
Alhamdulillah. Now come back to this topic. Capital budgeting applications include buying equipment, buying facilities, acquiring a business, developing product or product line, expanding into new markets. So all these things are known as capital budgeting. It means you are investing in that project by taking your money out from another source by foregoing something, right? Now, firm must accurately forecast. This is very important. You have to do a very strong forecasting while making capital budgeting decision. If you are unable to identify a very significant factor during this capital budgeting, your analysis will not benefit you, right? So planning is crucial because of possible changes in the market like inflation, interest, money supply, everything. This is very important. Very, very important, because if the like Pakistan, Sri Lanka, inflation is very high. Interest rates are also very high. Somewhere we have some tax consequences. Like here in GCC, you are nothing to worry about with the taxes. But if you move to the Europe or US, so they impose a lot of tax. So every opportunity has its disadvantages and advantages also. Like if you live in Pakistan or Sri Lanka, you are with family, you are living with your own culture, but there is a problem of high inflation, high interest rate, risk is there. So if you move to GCC, there is a opportunity of tax-free salary, but there is a disadvantage. They never give you nationality. So if you move to Europe, they might give you nationality after 2-3 years PR, which is called permanent residency. But the problem is the tax rate is very high. So, but once you get the permanent residency, your child education is free, everything is benefit, you will get medical is free. But here, the child expenses are very high. So this is close to Pakistan, Sri Lanka, Europe is far. So everything, I mean, when you take decision, you have to think everything about. Now, what are the costs, different type of cost considered in capital budgeting? This is very important. First of all, the relevant cost differ among alternatives. Like relevant costs are avoidable and may be eliminated by ceasing an activity or by improving efficiency, and incremental cost is also very important. Sometimes we have irrelevant cost, which is called sunk cost. Sunk cost is something which you incur, but it do not provide you benefit until unless you create some development. Like if you conduct a research and you spend a lot of money in research. So until unless you develop something on the findings of the research expense by itself cannot provide you anything. This is called sunk cost. Sunk mean, yeah. So if you conduct a heavy research and on the findings of research, you do not develop something, that cost will become your sunk cost.
If you develop something, then
No, again, that cost is some. Yeah, but the development will give you benefit in the future. Now the stages in capital budgeting, identification and the definition. So this is all about theory. The main important thing is, okay, I'll tell you the main important. Now let's move to the Excel. How do we handle this? Let's suppose here we have years. Here we have cash flows. Right, sir? Then we need to have discounting rate. This is very good. Okay. I mean, before going into the detail, let's suppose 0, 1, 2, 3, 4, 5. So there is a project of 5 years. And we are planning to invest $1 million in that project. Right, sir? And that project gives you inflows like this. First year, 200,000. Then 300,000. Then 300,000. Then 300,000. Then 300,000. Now, do you think that this is cash inflows? This is what you are getting from in future years. Let's suppose you buy some machinery or you invest in some business project. You invest how much? 1 million. And every year they will provide you the cash inflow like this. Do you think that this project is worth investing?
Okay, investment is now in 10 years. We will need to.
So we are putting 1 million. And these are the cash inflows. First year we get 200,000, 300,000, 300, 300. 100,000.
No.
Okay, let's have a check. It's sum.
1.4 million.
The sum is 1.4 million. So we are getting 4 million extra. So do you think that this project is worth investing? It's the end figure gives a profit 1. So yes, Sir Sirina. What do you think? Should we invest in this project or not? Other opportunity mean? Yeah, we have to compare with another one. Let's suppose for the timing there is only one opportunity then. Yes, brother. If we have only this opportunity, then what we should invest? Okay, you are absolutely right. Now, that is how we are learning this capital budgeting. Now, in capital budgeting, because we have already discussed that we need to cover, we need to identify the very significant factors that are associated with the decision-making purpose. Now, what we need to do, this is very important in finance, that we always compare the present value with the present value, not the future value with the present value. Always compare the present value with the present value. Okay, now this 200,000, you are taking it, we are breaking even the cost of project and we make. So this 200,000 you receive after 1 year. So this is the future value after 1 year. Now today it has worth equal to how much? This 300,000 you are getting after 2 years. This 300 you are getting after 3 years. You know, imagine situation like Pakistan and India where the inflation rate is so much high. Yeah, we have to discount, absolutely right. So we should have a discounting rate. This is very important. Normally in exams, the discounting rate is absolutely given. So that discounting rate is a rate that should be covering all the factors which we need to consider in order to find out the present value. It will have the inflation, interest rate, monetary value, political situation, everything. And obviously, this discount rate is decided by the experts, not by the ordinary people. they will sit together, they will come to a rate which upon which they have consensus with each other. So let's suppose here in Qatar, we believe that the interest rate is 7%, the inflation rate is 4%. So 7 plus 4, how much? 11%. And let's suppose the political and everything, we assume that the discount rate here is 15%. Let's suppose. So if the discount rate here in Qatar is 15%, and we assume that this remains constant. Okay. So we also assume that this situation will remain constant. So if the 15% will be the discounting rate, so we have to discount all the future values to find out the present value. And how do we discount it? We need to find out the discounting factor. This is very important. Discounting factor. And the formula for discounting factor is insert equation. So it will be 1 divided by bracket 1 plus r, then raised to the power, no, 1 plus r raised to the power t. This is the formula, brother. You just write this formula, please. This is the formula to find out the discounting factor. Okay, brother?
So the textbook which shows as an N, right? Period is N.
Yeah, yeah. Sometime N, sometime T, no problem. Now is equal to 1 divided by, sorry, bracket 1 divided by, again bracket 1 plus the discounting rate is 15%. And the raised to the power is cap. And the time is T. Okay. 1 divided by 1 plus R. R here we have C3. And T is A3. This is our discount. This is our discounting factor. Now you use calculator and find it out. You have to put like this is equal to 1 divided by, if you use the scientific calculator, online students, you also check whether you get the same answers. Please check it. Velu brother, Sony, please check it. You get the same answer? Excellent. Everybody, you get the same answer? Present value is so the present value is equal to this multiplied by this. Yeah, absolutely right. The present value is this. Perfect. Right, sir? Now, so for every year you have to calculate. I'm sorry because I'm asking you. You need to calculate it because I know student make problems in the calculation. So you saw getting variance since I'm not taking decimal places. So the total on my side is, what is the total?
9,186. 9,186.
So there is not,
9,186.
so brother, you see, do you think this project is acceptable? Why? Yeah. So this is, okay, now we need to find out NPV. NPV stands for net present value. This is very important concept, net present value. And how do we find it? We take, this is our initial investment, 1 million. And the net present value is, yeah, so it is minus 81,000. So this project is not acceptable at all. Because the rules, when NPV is greater than 0, we accept the project. When NPV is less than 0, we reject the project. And when NPV is equal to 0, we do not make any decision. Now imagine if you are in Pakistan or Sri Lanka, brother. In Pakistan, the interest rate is 22% and the inflation is 17%. So 22 plus 17, how much? 17 plus 22. 39. And the political condition, let's say 10% more, 49. So if I put 49 here, this is the power of capital budgeting. Now this is very accurate decision. If you do not consider the discounting rate, your decision will be problem. Right, sir? Perfect. Now, what does it say? Let's have a look here. Now it says that now we can understand it very clearly. Other consideration are effects of inflation on capital budgeting in an inflationary environment, page number 358. In inflationary environment, future dollars are worth less than today's dollar, right? If there is an inflation, the today's dollar is more valuable as compared to dollar in future. Thus, the firm will require a higher rate of return to compensate. If there is an inflation, the firm will require a higher rate of return. This is for sure. Because there is a risk of inflation. So post audits should be conducted to serve as control mechanism to deter managers from proposing unprofitable investments. So actual to expect cash flow comparison should be made and unfavorable variance should also be explained. The reason may be an inaccurate forecast or implementation problems. Individual who supplied unrealistic estimates should have to explain differences. Knowing that a post audit will be conducted may cause managers to provide more realistic forecasting in future. The temptation to evaluate the outcome of a project too early must be overcome until all cash flows are known. The results can be misleading. So it is the responsibility of the finance manager or the accounts manager to identify all the possible outcomes, inflows, outflows, discounting rate, everything, sensitivity analysis, inflation, interest rate, everything. So assessing the receipt of unexpected non-quantitative benefits is inherently difficult. Yeah, this is the, sometimes we have some inherent risks which we cannot assess. This is the limitation of this NPV, but at least it can provide you a generic good analysis. Now, qualitative consideration include the following. The effects of on the environment, an option may not have the highest return, but might benefit the environment. This is the qualitative consideration. Now, today, in the modern era, there is a lot of research going on green, go green or green HR, green innovations, because now environment is becoming problem for us. We are entering into global warming. So the business models who are not go green or economic environmental friendly, they are not getting passed through the government. They need to create a proposal in such a way that their processes should be environmental friendly. Otherwise, they are not getting approval. So additional job opportunities that may be created in the community, this consideration should also be taken care of. I mean, the project in which you are investing in, will it provide job opportunities for the community as well? This is called corporate social responsibility, sustainability, environmental, everything. The overall growth strategy for the company might be enhanced by accepting a project that will initially generate a loss or a lower gain than the alternatives. Then risk analysis and real options. So risk analysis attempts to measure the likelihood of the variability of the future returns from the proposal capital investment. This is a definition of risk. Risk means the probable variations from the desired outcome. The probable variation from the desired, it's called risk. Now, why the word probable is associated? It means that you should calculate that if I go into this project, right, how much my result would go beyond my expectation. And that should be in percentage, 20%, 30%, right? So you should play with calculated risk, not go for uncalculated risk. Right, sir? The following techniques are there in formal method. NPVs, which is also called net present values, are calculated at the firm desired rate of return. And the possible projects are individually reviewed. If the net present values are relatively close for two mutual exclusive projects, the apparent less risky project is, if the two are mutually exclusive, I mean, they do not have any interrelation with each other, then obviously we will choose the project which is less risky. Now, risk adjusted discounting rate. This is what we have discussed. The discount rate of a capital investment is generally the company's cost of capital. So if you remember, we have gone through company cost of capital in CAPM model, if you remember. And how do we calculate the cost of capital? It is the sum of cost of capital, the sum of plus RE, right? Return on dividend, return on equity. And how RE was calculated? CAPM model, risk free return plus beta bracket market return minus risk free return. Remember, which is called CAPM model. So that is how we calculate the cost of capital, and this discount rate is basically the cost of capital. However, when a capital investment is more or less risky than is the normal for a company, its discount rate is adjusted accordingly. The discount rate is increased above the company's cost of capital for the riskier project. If there is more additional risk like inflation, interest, monetary value, political instability, then your discount rate will be higher than the cost of capital and decrease for the less risky project. That discount rate may vary among capital investment depending on the company's cost of capital and the type of investment. Additionally, some investments may be accepted with the internal rate of IRR. This is very important. Now let's understand what IRR is. IRR means internal rate of return. Now the problem is, brother, we need to find out a rate we always try to find out a rate that should give us NPV is equal to 0, because we need to find out the threshold value. What rate gives us 0 NPV? Let's suppose here, if you take this case, the similar case, now just have a look here. Okay, if is it possible if I ask you to find the same for 5%, can we do this? Yeah, please calculate it. Same question for 5% discounting rate.
From 1,203,603.
If we put 5% here, it gives you positive cash flow.
Yeah, positive.
Same answer.
We are getting NPV positive.
What is the NPV?
203,000.
Yeah, same answer.
Same.
Yeah, you just look at
Right.
203. Okay. Now we have to find out IRR, and this is the formula for IRR. The rate at which your NPV becomes 0. The rate at which your NPV becomes 0. So now, what is RA? RA is the discounting rate of positive NPV. RA is discounting rate of positive NPV, which is 5%. Absolutely right. Absolutely right. Then we have discounting rate of at which NPV is negative. And this is your RB. So it is how much? 15%. Then NPV at RA, which is called NPVA, which is this. And then NPV at RB, which is NPVB, which is this. Now you put into the formula. Okay. Is equal to bracket. RA is 5% plus, sorry, 2 bracket, 1 bracket, 1 or 2. Okay, RA plus bracket NPV at A divided by bracket NPV at A minus NPV at B, bracket again bracket RB minus RA. 12%, brother. You calculate by your calculator, because in examination you have to use it. Can never be, because listen, brother, it should be in between 5 and 15. Why? Because 15% is giving you the negative and 5% is giving you the positive. So we are searching for 0. This is very good question, and this is the that is how we can check our answer also. It should always be in between. Right? So 12% is the rate at which NPV is 0. So we can say NPV is greater than 0, 5%. Right, brother? NPV is less than 0, 15%. And NPV is equal to 0, which is called 12%. So now we come to know that at this rate, the NPV will 0. So we should always aim for the lower rate as compared to IRR. If the rate is equal to IRR, we cannot make any decision. If the rate is higher than IRR, we will always have negative NPV. Want to note something?
No.
Okay. Now we move to. Now we have some sensitivity analysis. I mean, let's go through it. It says certainty equivalent adjustment. This technique is directly drawn from the concept of utility theory. It forces the decision maker to specify at what point the firm is indifferent to choice between a certain sum of money and the expected value of a risk sum. The technique is not frequently used because decision makers are not familiar with the concept. Then we have simulation analysis. This method represents a refinement of standard probability theory. The computer is used to generate many examples of results based on various assumptions, right? So it's a simulation analysis. The computer will give you. Project simulation is frequently expensive unless a project is exceptionally large and expensive. Full scale simulation is usually not worthwhile. Then we have sensitivity analysis. This is very important. Sensitivity analysis means forecast of many calculated NPVs under various assumptions are compared to see how sensitive, changing the assumptions and everything. Now, let me show you the sensitivity analysis. Is this clear now? 100%. Any problem? Now, what sensitivity analysis? Okay, let me share you this file with so that you can also download this file and play with the figures for better understanding. Technology makes easier, huh? If you use how to work with it. Otherwise, it is tension. CMA part 2, capital budgeting, right, sir? So here it is. Now let me show you an example of sensitivity analysis so that you can understand better how would it work. We go THM, level 7 accounting and finance, strategic financial management, week 3 probably. Yes. So brother, this is called sensitivity analysis. Brother, what is the time of our class?
3.
You live India or Qatar? Because in India right now it's 4, it's 3.
Yeah.
Or you are living in Dubai?
Dubai? No.
Right now, in Dubai there is 3.
I'm living in Israel.
Come here, please.
Sir.
No problem. Because if you cannot come in time, do download the recordings. Do you do that?
Yeah, of course. From Zoom.
From Zoom, very intelligent.
Yeah.
So after this class, tomorrow, the management will share link in the group. And that link is only workable within 48 hours. So you have a very specific time. So if you download that link, that video within 48 hours, it will work for you. Otherwise, the link is gone, expired. So it's okay if you come late or if you miss any class. That is why we are always recorded session. so that you can have downloaded it, right?
Yeah.
Now, brother, sensitivity analysis is something which we need to understand, because there are some things which are very sensitive. Sensitive mean, what do you mean by sensitive? We used to say sometime that brother Ibrahim is very sensitive. What does it mean? If we say someone is very sensitive, what does it mean?
Sensitive?
Yeah, if you say Saram is very sensitive, what does it mean?
You mean, I think I don't.
You don't know?
Is
No,
it
if we
that
say
they are-
something like you say about your colleague that she is very sensitive, he's very sensitive.
She behaved with her feelings or his feelings.
Yeah, sensitive.
Reaction.
Yeah, sensitive mean a very major reaction on a very small, yeah, incident. Okay. So if you a very large reaction on a very small event, this is called sensitivity. So that's why we say that he is very sensitive, she is very sensitive. So there are some variables which are very sensitive. I mean, they keep on changing, and because of their movement, the whole analysis will get disturbed. Now let's have a look here. Let's suppose we have here. Okay, rest of the things are very similar, brother Serena. I mean, if I remove these columns, the rest of the NPV is very simpler. What we did? Wow, you are very intelligent, mashallah. May Allah bless you. So, units, per unit selling price, cost, these are the things which are highly sensitive. Because units sometimes you produce more, sometimes you produce less. Selling price, sometimes it's higher, sometimes it's lower. Cost, sometimes it increases, sometimes it decreases. Profits, sometimes it's varies. So because of their fluctuations, the inflows gets disturbed. And because of change in inflows, obviously your present value and everything will get changed. This is called sensitivity analysis. And obviously discount factor by itself is very sensitive if you are operating in a very volatile economy like Pakistan, India. I don't know about Algeria. Algeria is a stable economy or volatile? What is the inflation rate in Algeria?
Maybe 0.0008.
Inflation.
Yeah.
It means 3%.
I don't have the right answer.
No, I think Algeria is a very stable economy. Let me check it.
It's between stable and not stable.
Inflation rate in Algeria.
Yeah. It's not that good.
Yeah, no, it's okay. I think everything which is within the range of 10 is good.
Yeah, it's not it's not war country. Something.
You see, in Pakistan, it's 19.87%, and it is in 2021. Now, currently, it is more than definitely it is more than 25%. And most of the time, the inflation they calculate, they do not report the actual groundings, because they show the documented. In reality, it's very different, because like this is the inflation of the country, the whole country. So Lahore, Karachi, very different. Every area has its own. You see, because if the country inflation rate is 20%, the individual inflation rate would be very volatile. You understand what I'm trying to say?
Yeah, of course.
Because this is the base inflation rate now.
Even this, I think, for the prices of the things that the government sell. But if we talk about the individual, it will be more.
He's very intelligent. That's why he comes late. I know you are intelligent. That's why you come late.
I'm not intelligent at all.
This is what the government selling price. The price is at the government end. But if you consider private or anything, the inflation will go more high. Sri Lanka. It is falls by, but what is in 2023? Brother, very. Now have a look at Argentina. I think recently, what happened to Argentina? Because they won World Cup?
No, the thing is because they, how say that, it's how say, their policy, they take a lot of loans from the international bank.
211%.
Yeah, crazy.
No, but they have won the World Cup, FIFA World Cup.
No, but FIFA World Cup, it's they win the football, but in economy they didn't win. They are still losing.
Very high.
It's, I think from 30, more than 30 years, they are taking loan from international bank. Then when they come to pay them, what they do, they take a lot of loans to pay this loan, and the loan is more big.
Yeah.
Japan is only interest rate minus.
Yeah, yeah.
Because of the.
You are absolutely right. You are absolutely right.
Because of what happens in 89.
No, Japan is, you see, it's minus point. You're absolutely right.
Yeah.
So if you take loan from Japan bank, they will even give you discount.
Yeah.
I mean, if you take 100,000 Qatari Riyal from Japan bank, in return you might have to pay 95,000. It's 5,000 discount even. Even bank are offering discount, and even then people are not taking loan. It means people are very self-independent. Amazing.
Because the issue that they didn't have in the past.
So, brother, let's suppose if the discount rate is 12%, basically I made this situation. Let's suppose we have two countries, right? We have one country at where the discount rate is 12%, other country where the discount rate is 3%. So if the prices and the cost remain same, still we get different answers. You see? Here the NPV is higher, and here the NPV is lower. How? Did I make some wrong calculation? Brother, if the discount rate is higher, then obviously NPV should be lower now. Where is the problem? Oh, sorry. This is 30%, not 3%. So maybe this is Pakistan, or maybe this is Qatar. So if you operate with the same commodity in Qatar, you will have NPV positive. I mean, project acceptable in Qatar, but with same structure, the project is not acceptable in at each time. So we can change these units or prices to understand more. This is called sensitivity. I think you can understand what I'm saying is your selling price may go up. Let's suppose in first year it is 300, then it is 310, then it is 320, then it is 330, then it is 340. Maybe you producing more units, let's suppose 220, 240, 260, 280. So this is the use of technology. I mean, with change in particular segment, you can have all the scenario in your tips. You can see, yeah, okay, this. This is called sensitivity. And let me share this with you as well so that you guys have more better understanding of. I'll also share this file with you. Save. Session 3 now. 9 OTHM. I have one more student in my level 7 leadership. She's Amira from Algeria. Amira.
Yeah.
She is from Qatar Airways. She is my student in OTHM level 7 leadership. She's also from
Is your student
in OTHM. It's a certification, level 7 leadership. Leadership. Leadership is a course.
What
Like you are teaching CMA.
Uh-huh.
So it's a leadership course now. I'm
Uh-huh.
also teaching that,
Okay.
Yeah. So her name is also Mira. I told her that I have another student from Algeria, but he is not regular.
It's okay.
So, brother, I have shared this file with you, okay, for sensitivity analysis. Now, this is what sensitivity analysis is. Then we have Monte Carlo simulation. Is used to generate a probability distribution of all possible outcomes from the. This is very, but this you use through software. No? I'll teach you in Strata in next class, inshallah. How do we do this Monte Carlo? Then we have real options. This is all about theory, risk tolerance, uncertainty. Then time value of money. So we have discussed everything. I mean, if the rate is 6%, if the rate is 8%, if the rate is 10%, what are the present value of everything, right? So the present value of 1,000 to be received in 3 years and discounted at 8% is this. So if we have, now this is the future value. Now there's a difference between future value and, okay, brother, Sirina, the formula to calculate the discounting factor is CMA part 2, capital budgeting. Now this is the formula to calculate the present value. This is the formula to calculate the present value. And what is the formula to calculate future value? You can also calculate future value as well. It is simple, 1 plus r raised to the power t. Okay, let me write it here. This is the present value formula. This is the present value formula. This is IRR formula. And here we are writing the future. Insert equation script. Yes. So the formula is simple. 1 plus r. One plus r raised to the power t or raised to the power n. This is the formula. So when you multiply it with the value, it gives you the future value. Okay, brother Sirina? Sorry? To write the formula? I'll teach you. It depends upon the nature of the equation you are writing. So let's suppose if I want to write an equation of discounting factor, then I go to insert, then I go to equation. Now here we have different options. So let's suppose I select this fraction because I'm writing the discounting. So I will use this one. So I put 1 here and down. I further go to script and I select this because I have something which is raised to the power. So it will be 1 plus r raised to the power t. It is like this. So it depends upon the nature of the, you can write any kind of equation. If you go to insert, just have a look at equation. There is, I mean, mathematics, everything, sign, bracket, amazing. Even you can write the matrices as well. Very nice. Excel has everything, mashallah. I salute the people who invent this Excel. So brother, how do you calculate the future value? It is very simple. This is the formula I just show you. Okay, let me show you how do we calculate the future value. So this is the formula. Sorry, I have to remove this one. So let's suppose we have here. So today we invest 0, 1, 2, 3, 4, 5, 6. Right? Investment. So let's suppose brother Ibrahim, he invested 1,000 Qatari Riyal in a saving scheme, and every year he invests how much? 1,000. Every year you invest how much? 1,000. So here we have what we called, that was discounting factor. Yeah, this is compounding factor. Compounding factor. Or I think I should write like this. This is 1,000 in year one. Yeah, I should like this. 0, 1, 2, 3, 4, 5. Next year he also invest how much? 1,000. Then he also invest how much? 1. Then he also invest how much? Then he also invest how much? 1. Then he also invest how much? So in first year, it will be 1,000 multiplied by 1 plus, what is the discounting rate? Let's suppose here in Qatar we have 7%, no? So
0.007.
yeah, very, very right, mashallah. So it will be like this. Raised to the power. Yeah, I mean, it's okay. I mean, just leave it. So I just want to teach you the concept of future value. So let's suppose if he invest today 1,000, after 1 year it will be 1,070. After 2 years it will be like after 6. So this is a future value. So brother, 6 years from now, 1,000 Qatari Riyal is equal to 4,000 Qatari Riyal. So imagine the worth of compounding factor. What is your salary? Let's suppose you are earning 10,000 right now.
Sure.
No problem. So if you are earning 10,000, after 6 years, it should be 41,000. But normally, it doesn't happen.
Huh?
Normally, huh?
I think this inflation is more than the norm. So after 6 years, 41.
I think I should keep everywhere this is F4 now. So here most F4.
That's the thing.
Sorry.
Yeah. Four.
Yeah.
Uh,
So he should be earning 15.
this is normal.
This is
It's normal.
so brother, then we have okay, we have present value as well. We have annuity value. I'll give you this table, na? Present value annuity. I think I have this. Let me check it. If I have this, I'll share it with you. I know I have this in CMM-I probably. Session 2, Session 3, Session 4, Session 5, Session 6, Session. Yeah, this is brother Srinath. I have shared this annuity table and present value. Just go through it. Everything is given there. Now let me open it for you. You see, this is the present value. If the discount rate is 9% after 5 years, it gives you this value. And again, we have annuity table. This is annuity table. So I'll share with you. Try to take it with your exam. If they do not provide you, you should have this annuity table. This is very important. Then we have net present value. We have already discussed this, everything, you know, the inflows, discounting factor and everything. Then we have present value, IRR, we have gone through this. This graph is also similar what we have discussed. Now, another very interesting concept, which is called payback period. So the formula is initial net investment divided by annual expected cash flows. I mean, this is not as much accurate as NPV. This is a very traditional type of formula. NPV is advanced. So again, they use this thing. This is very simple. I mean, I would not encourage it to use, but yeah. Then we have another technique, which is profitability index. Just go through it by yourself. So we are done with this chapter, mashallah. Now we have only 1 week. You just go through all the questions with you. So how many chapters we are left with? Let me put the attendance first. CMA part 2. So how many students we have? Online we have 2. Oh, 4. Wow. Amna, Velu, Soni. Okay. So we have no. Ibrahim is always present. No. 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 Velu. Amna Rias, brother Sirina. And the next one, his name is Shirishan. Yeah, he's always present, Mashallah. So, ladies and gentlemen, thank you for today's session. We have done this, but let me check how many chapters we are left, brother. Okay, so we have this CMA. So 1, 2, 3, 4, 5 we have done. 6, 7, not 6, 7, 8, 9, 10, 11. And rest of the things are done. Risk management is done, investment is done, ethics are done. So how many chapters are remaining? 6, 7, 8, 9, 10, 11. 6 chapters. Inshallah, by the end of June, we will make it khalas. Anything else? Thank you, brother Velu. Thank you, Sirishan. Thank you, Amna. Allah Hafiz.